want to talk from just a pure mathematical standpoint. I would be better off taking the 4%, taking the additional 2% that I would have paid the insurance company, not me. I would have more money in that scenario.
I could prove you wrong mathematically.
Chris, respectfully, you can't, because this is like pure math. Talk to me about why you use IBC for cars, because that's probably the biggest disagreement we might have on the internet.
Because I bought a lot of cars in my life, and every car that I used to buy, for the most part, I would always finance them. I had this relationship with a credit union here, and literally, like, I think I did like 40 car loans. I held a record there for a long time. And when I learned about the infinite banking concept, it was so simple to me. It made perfect sense. You change one thing, where your savings goes first, because I was already saving money, not a lot back then, but enough. And then add one step. And that step was just, I like to call it Monopoly, right? I'm just playing real world Monopoly. I'm moving my little chess piece, or my little, piece around a Monopoly board. And every year I'm passing go, which means I get a dividend. But along the way, I'm finding jobs for my money. So I'm relating this back to yours. So as I go around Monopoly board, okay, which is the equivalent of 12 months of the year, what I'm doing is I'm finding places that I can make my money go to work. And then I'm putting some money into various things, some real estate, some private lending, but cars, right? I have a family, and I collect Porsches, so that's a problem. But, we also have 2 cars in our family that we drive every single day. And I just simply did the math. I did the math on how much money it would cost me to finance those at the lowest offered loan rate out there in the industry. And when I started doing that, I was kind of astonished.
What interest rate was it coming?
It depends on the time period when I did this. I mean, going back to when I first started this 10 years ago, you get a car loan for 3-4%. Now today it's like 6, 7, 8. Well, keep going. I mean, but that's where you're at. But back then it was 3-4%. But here's the thing. When I added up how much I was paying and losing, on cars, it was pretty astonishing at 3-4%, which you cannot get a car loan today at 3-4%. So then what I did is I literally just ran the math of, what if I did it through the policy? And what if I just paid myself back the exact monthly payment that I would have paid a bank? And this whole first thing, I did it with several cars, but the first one that I really documented was when my wife, we found out she was pregnant. I bought her a Porsche Cayenne, because the car we had was just always in the shop, and it just wasn't a reliable vehicle. So we bought her this Porsche Cayenne. It was used, and we were negotiating with the dealership. And I remember she got so mad at me because she knew we were paying cash for the car through a loan with our policies. But I was playing this game with the sales guy, and he'd go back to the manager, come back, slide me over the rate. I say, no, you got to beat this. And I was just playing off the monthly amount. I wanted the lowest monthly payment for the car. This is how everybody buys a car, and this is why I did it. 3 or 4 times back and forth, and he slides it over. He says, Chris, I'm sorry. This is absolutely our final and best. There is no better offer we can give. And I look at my wife, and she's just still pissed off, because I'm just playing games. And I said, yeah, I'll take that. And he's like, great. I said, you got a deal. So he then slides this big pile of paperwork over the credit applications. And I slid it back to him and said, I don't need this. And he said, well, why? And I said, well, because we're paying cash for the car. I said, I'm doing this through my private banking system. And he says, well, why did you have me going back? He was actually pretty pissed off. And at this time, I did not know dealerships made money on financing. I just thought this was just a convenience they did to get people to buy the car where they made the money. No. They make money on the financing. And later I found this out, that I actually kind of screwed him, because he had negotiated the price of this vehicle down because they factored in that they were making money on this financing, to which I just stripped him. So he then says to me, he says, well, why did we do all that? And I said, well, because I had to figure out what the lowest monthly payment would be for me to pay my bank back at, my banking system. He didn't understand it then, but that was the whole thing. So when I buy cars, I always make a car payment, but I make a car payment back to myself. So let's just take the policy right out of this. Okay. This is where I get a lot of hate. The infinite banking concepts is a process. Yes, they include the whole life insurance policy because it makes it more efficient, but it doesn't have to be included to have the infinite banking concept work, the banking function, if you will. You could use a bank account. You could use a 401k. So if I just did what I just explained with a bank account, I saved up enough to buy this Porsche. I paid cash for the Porsche. I made the exact car payment I would have made to the Porsche dealership, but I made it back to myself. Well, I'd get all the money back for the car after 5 years plus the interest. So then when I started doing it with the policy made it just a wee little bit better. I had a little bit more money. And plus, I had a death benefit. And plus, my money was protected from judgments and liens and all those green check marks. So you can agree to disagree or just agree, like it's just a more efficient way to buy cars. And I have bought no less than 20 vehicles using this system. I've gotten money back on all my money back on every car. And now I even play it now. Like I got a G-Wagon right here that I just sold. Kind of a stupid overpriced vehicle, but nonetheless, I financed that one through. I overpaid for the vehicle. I did.
Yeah.
Like, because it was after COVID. I overpaid for it. I knew I overpaid for it, but it didn't matter because I knew if I made payments back to my bank, I would close that gap. So I just sold the vehicle for $134,000, and most people would have lost 40 grand on that deal from what I paid to what I did. But I actually made money because I was ahead of the game because I used the infinite banking concept to buy it. So that's why.
Okay. I can we hash this out as we land the plane?
Sure.
Okay. I I I think you know how Nelson talks about volume versus rate?
Yeah.
And I think the pure goal is to help people save more money. And so there's no doubt when people are motivated by things like cars, they will find ways to just save more. So I want to acknowledge that. And then I want to talk from just a pure mathematical standpoint. So we both have cash value available. And I could, let's say I'm going to buy a car and my policy is at 6%. I'll just say that I can access it. I'm gonna play both ways here. And let's say I could get a 4% loan, and my whole goal is to save more money to increase the capital. I will be able to have more money for the Guilliams Capital Life Insurance if I take the bank loan, take the difference, and put it in forms of PUAs or premium.
What I didn't catch something. To take what difference?
So this scenario number
6
one
to the 4?
Yeah. So if I could borrow at a car dealer at 4%, and I could take a loan at 6% from my personal bank, I would be better off taking the 4%, taking the additional 2% that I would have paid the insurance company, which is not wrong. They're not, but it would go to the insurance company, not me. And I would have more money in that scenario. That's where it's like
I could prove you wrong.
No,
mathematically,
Chris,
every day.
respectfully, you can't because this is like pure math.
I know, I know the math, but I could because you're missing a key
do
component.
it. This will be like the
Well, we have
greatest thing for your
software. We
channel
have
because we'll
software
just
that
like
does
come up.
that. But
like,
so I can
you
explain
won't,
how.
because that's not how the math works.
Well, it does. So hold on, because when you take the payment, okay, that you're making, so take your car payment that you're making at 4%. If you just take that same exact car payment, because you could get a loan from the bank at 4%. So don't make your loan more just because your policy loan interest rate's 6. And if I took that loan payment and I paid it back to my policy, recycling and recapturing it as a loan repayment, what happens is after 1 year, I didn't pay 6% to the insurance company because I've been paying down the loan. So the APR is more like 4% at that. Second year, I'm doing the same thing. My APR, because I'm paying interest, simple interest on a declining balance, the APR is now in the low 3% range, and then 2% the next year. And I'm working off of a 5-year loan. So when you average that out and you average the APR, the interest you actually paid to the insurance company, not the interest that the insurance company was charging, you are way ahead, even at 4%. Mathematically certain.
Okay, can I be a little late, and then and I have time. I don't have a.
I'm happy to show the math. I need a calculator. You got a calculator at your fingertips. I don't.
Yeah. So let me just do
because you got to factor in what you could earn on that 2% difference and roll that back into the equation. But I think you'd be hard pressed.
I'm assuming the same thing. So this is where this is where I think. And this is not a get you. This is probably the one biggest.
Oh yeah,
thing.
no. Because go ahead.
You know me. I'm not here trying to. Okay, so you have. Okay, we're gonna do Chris and Caleb, right?
Mm-hmm.
You have Chris and Caleb. Okay, just to make math extremely simple, we're gonna say the payment, and let's say we have cash value. Can we both agree that? Let's just say these are identical policies.
Sure.
So we have cash value over here. Cash value over here. Okay, we're gonna let's say let's say the payment is $1,000. So the
Yeah, simple math. $1,000 a month car payment.
we want to buy a car. We want to buy a car. Okay. And let's say, and we're already funding our policies, so none of that is going to change. And let's say the car dealership over here will give us a payment at 1,000.
Yeah, call it 4% interest.
Okay. So $1,000 payment, or I could take a policy loan at 1,200. Just assuming that it's a little bit higher interest rate.
Well, yeah, but don't assume it's a higher interest rate.
Well, that was my first assumption is 6% versus 4%.
See, I wouldn't do it that way.
Well,
I would pay myself my policy back the exact amount I would have paid the bank, and if the bank's offering a loan at 4%, I would pay myself exactly what the bank was offering and the dealership was offering.
Well, okay, so but that's just that's a talking point that I've never heard before because I don't. So
Well, I think it's silly. Nobody in their logical mind would pay more just to pay it back to themselves when they could get it cheaper from a bank.
Okay, so you do agree with me that
100%.
in this scenario, you would take the bank.
No, I would not.
Okay.
We haven't got that far. But what I'm agreeing with you on is the $1,000 car loan that you could have got from the bank. Okay. I would only, if I was doing it from my bank, my policy, I would only pay my bank back $1,000. I would not pay my bank back more. Like that's,
so you would
pay,
even if your interest rate was at 6%, you would pay an equivalent.
Because what I just explained, it won't matter in a second. But yeah, but just put $1,000.
I think that's a person. I don't necessarily think that matters to the equation. But okay, so here we go. So Chris, in this scenario, you're going to take a policy loan, and again, like just hear me out. You're going to pay $1,200. Trust me, I'm not going to be weird with math. I'm going to take the 1,000, and Caleb over here is going to put an additional 200 into my policy. So we're the same cash flow is the same, but Chris, I'm telling you, over time, Caleb will have more money than Chris in this scenario, because
this would be a cool part too, because we can model this.
Yeah, but Chris, there's nothing to like Chris, you're paying back a loan. These are the same. This is identical policy. What's going to be better? What's better for the policy? A loan repayment or new premium?
Okay, that's a simple one. A loan repayment in this scenario would be better because you're talking about a 6% loan rate. So if I'm repaying the policy, but see, the difference is, and I know how you're modeling this, and you can continue to model it this way, but I would be paying my policy back $1,000. If you're saying the cost is $1,200 at 6%, because you're saying that the 6 versus the 4 is a $200 delta. Okay, so that is true the first month. But the second month, after I make $1,000 payment back to my policy as a loan repayment, that is not true anymore. And then the next month, so every month I'm paying $1,000 back, which means the insurance company is no longer charging me $1,200. They're charging me with the 6% on whatever the declining balance.
The reason why it's a half truth, respectfully, because you're not wrong, but you're not
operating. I'm 100% right.
Opportunity cost. You're looking at
right. I'm not talking about the opportunity cost at this point. I'm just talking the math on
what
the top
I'm saying
part.
is this is what I'm saying.
You're talking about the $200 going into the policy. Is that going to outweigh? I've never run the math on that, but I'd love to.
But it's not like we don't even need to run a calculator, because just do the logic. If we have the same exact policy, I'm not talking about I'm just talking about the same exact policy, and we have $100,000 in both. Okay, you took a loan and let's say non-direct recognition. So you took a loan again. So I technically have more capital than you to begin with, because I'm taking their money over here. I'm holding on. Now that could be a good thing or a bad thing. As an entrepreneur, I'd rather have the money and options.
I'll agree with you.
Options. That's a different talking point.
I agree with you on that.
So then what in this scenario, if we're taking the same 1,200, Chris over here is putting all 1,200 back to repay back the loan. Okay. Whereas remember, your policy is going to be identical. These policies are growing identical. All I'm doing is Caleb, am putting an additional 200. So not only do I have all of my 100,000, whereas you're now paying back, getting back to that 100,000 of liquidity. Our policies are growing the exact same. The only difference is I'm adding 200, and logic would say I'm adding 200 to this scenario. I'm going to have more money over time.
I'm not going to agree. I will run the math because it,
Okay.
to me, is not as logical as you're making it out to be, because you're using your numbers and your logic. I get it, but I'm just a mathematics guy. That's why we created the Vault software, is to prove mathematics and to run multiple scenarios in one particular example using the policies. So this is a very simple thing. And I think it would be a sweet second podcast to kind of just hash this out. Now, I'm not saying you're wrong. I'm just saying, let's let Matt
and
prove
then
it.
maybe on the next episode, like I'll even talk like from a math standpoint, but then I could even make the argument, and I would be wrong. I could make the argument that this, let's just say this payment's 1,400, 1,400. I could still make the argument that I would still take the loan from the bank, even though mathematically I would be less behind, because it would be obvious that you would now have an additional 200 that you could put into your policy, apples to apples. You would actually be ahead, and we could have a conversation around like, why would I take precious capital, put it into a depreciating asset or an asset, doesn't matter, that a bank will give, when like I have access to like money. So for me, that's a whole different. That's not I'm admitting that.
Yeah,
in
that is
scenario,
a personal preference thing. That really is, and I can I can answer for myself. And I've gone public, on my YouTube and my webinars explaining this over and over. Several years ago, like when I started buying the Porsches, I've always loved Porsches since I was a little kid, and I never had one. So now, I have 5, but it has nothing to do with the Porsches. Okay, so please don't hang up on that. What it was for me, I saw a declining economy. I saw a future investment world that was not safe and was not secure. And I was pulling money back out of investments, okay, real estate investments, selling real estate, closing out loans that I had done on in that. And I had all this cash value, and I did not have anywhere for that money to go to work. Okay. I have no debt outside of my mortgage. I have no debt. Okay. So I was in a kind of, this is a personal thing. I needed to move money. I needed to do something with that money. So I started using it to buy this car collection. And also, this isn't why I do it, but this is just at that point why I bought more cars with this versus investing that money or versus financing it. I needed to move capital. Okay. Now I know that doesn't apply to some of the people listening. This is a personal preference, and every client, every person listening will have a personal preference on where they move money and what they invest in. This was just mine. It was the safest place, because right now, if I go to a bank, a car loan 6%, if I pay myself back at the same exact rate I would pay on a car loan, 6%, that to me is a good return on my money. It really is. And the arbitrage, if you will, from what I pay the insurance company, the cost of capital, to what I'm earning on the 6%. So most would say, well, if you're paying the insurance company 5 and they're charging, and you're paying the loan back at 6, you're making a 1-point spread. I'm making way more than that because of the velocity of money and the APR. The APR is the number I'm using. Yeah. So every year I'm getting a higher and higher return on my money, and I'm taking zero risk. So for me, the cars is really just maybe a privilege that I have, where I have capital to do this that isn't going to affect my outside business, investment, capability. So I have liquidity. It just, to me, was a better place to move money than anything else that I could find.
Yeah. So you would agree with me that if someone had a liquidity choice between an asset or a liability, that they may be mistaken if they take all their precious liquidity and put it into a car.
The thing I would actually, and I've been talking about this with Devin a lot, is one of the things right now, there are a lot of cars out there that lease out phenomenally well. Like I'll just use Jeeps, for example. They have a really high residual value. So if you go to lease a Jeep, like you could get a $60,000 Jeep for like $600 a month. If you were to try to finance that, that's over $1,000 a month. So like I would tell people, all right, listen, like if you got the money in the policy and you have debts or you have something else we can use the money in the policy for, go lease. Find a vehicle that leases really well from a residual standpoint, negotiate down the factoring rate, which is the interest rate they charge in a lease, and get a good deal on a lease. And then you're driving a brand new car, you feel good about it, but then take the difference from what that lease is that you're paying and what you would have paid yourself back at, which is a going financing rate, which is about 6% right now, and then reinvest that back into another policy. Then you'd certainly be ahead. I just, I think there's a lot of ways to play that. I've never really gone public with that,
Yeah.
so this is the first time I've mentioned that, but we talk behind the scenes about it all the time. I don't think that's a bad strategy at all. I
Okay.
just think people make a lot of mistakes. So it's from the public standpoint, it's just easier, and I think you can respect this. It's just easier sometimes just to teach the one way, and then people can kind of figure out the logic behind what's best for them, or work with us to figure that logic out later.
I think that's what Dave Ramsey, I'll give him flowers. He's very consistent. I think behind closed doors, he's not an idiot. He knows if he can get a 0%
No,
loan,
behind
put it
closed
into
doors, he owns
treasuries.
whole life.
You know, if you can 0% loan put into treasuries, you're not really taking on any risk. But he's being consistent because he knows when he gives an inch, people get more confused. And what you're saying is, hey, like every case is going to be a little bit different, but I had Carlton Dennis on the other day, and he's talking about like, hey, I'm not giving tax advice when I'm on TikTok. I'm getting people to think different, but obviously when they work with me or our team, it's every situation is going to be the same. But I'm trying to like inspire and tell instead of telling them no. And I do think, to your credit, there's many people that are starting to save more because of the desire to buy a dream car. And by that desire, you're getting them to save $3,000 a month instead of their $1,500 uninspired. And it's really hard to compete if you're increasing someone's
Absolutely.
savings rate. That's not a math problem. That's a heart problem. And
That's
it's a
true. It's
motivation.
an
So
emotion problem, and that's the most powerful thing when
yeah.
it comes to money.